While oil prices have increased due to limited global supplies and concerns that the OPEC Plus group will not be able to pump additional petroleum, the group stated on Thursday that it would keep to its planned increases in oil outputs in August. However, the meeting avoided debating strategy moving forward. Now, days before U.S. President Joe Biden visits the Middle East, including Riyadh, where he is anticipated to press the monarchy for more oil, the group that includes Saudi Arabia, Russia, and other significant oil producers met on Thursday. Joining me is Desmond Agboifo. He's the energy expert and director of Desyton Energy. Desmond, welcome back to Business Edge again. Thank you. Let's quickly get into this.
Thank you very much.
Apologies there. We see OPEC defying calls to pump more oil to cool this really red-hot market right now. And producers have agreed to stick to the planned output increase in August. What do you think is the rationale behind what OPEC Plus is deciding?
Thank you and good morning once again. I think it's actually expected from OPEC in this time where we have a bit of a mix and match of issues that befalls the industry. I mean, we've seen clearly how the prices has grown, from low levels to about $139 a barrel in March, and even we're still around the 3 digits even till now, up until end of first quarter of this year, which is just yesterday. But the key reason about this is that it must be very clear that we must understand that the supply scarcity, of course, often outweighs our recession fears. Clearly, we can see that the big guns of OPEC, which is the Saudi Arabia and the UAE, are really in a struggle to ensure that they keep their productions at optimal capacity, vis-a-vis the concerns around the refining capacity of these oil prices, which has perhaps even declined markedly. So it calls for some concerns, and with the introduction of the OPEC and the new OPEC members coming out to be OPEC Plus members now, which is the new buzzword now, it's becoming even much more essential that we need to see how to manage the expectations from productions and also trying to sustain the economy supply.
So that production conversation has been one we've had this year already, I think about 2 times, and oil prices slipped on Thursday afternoon amid concerns about the global supply. And this comes with the suspension of Libyan oil exports from key ports and also a fall in outputs from Ecuador due to ongoing protests. Do you think OPEC Plus can meet this increase, however slight, however underwhelming it may be for some people?
Well, in my impression, I think it would be a struggle, almost perhaps even speaking very optimally. It would be a struggle because in total, OPEC member countries are pumping just about maybe perhaps about 70% of the total global oil production. And when you look at the total global requirement, it's just about 86 to 87 million, which is even down from last year levels of about 96 million barrels per day. But yes, what we expect from the members of OPEC should be, of course, tightening their belts. But again, it also calls for a bit of much more capacity improvement because the plan is always to produce more. And when you produce more, of course, the market will always respond by having some bit of oversupply. And when that happens, the price will also come down. So OPEC is trying to ensure that the prices and productions are a bit at par with themselves so that we can sustain productions. Countries can leverage of their oil that they produce, and of course live within the confines of their revenues. That's also very key.
And it's interesting you bring up capacity because this has also brought up the issue of the spare capacity. So let me just take you through this. French President Emmanuel Macron said he was told by the UAE's president that both the UAE and Saudi Arabia can barely increase oil production. And he was heard speaking to President Joe Biden on the sidelines of the G7 summit this week. And they said that the UAE says they're even already at maximum production capacity, while Saudi Arabia might be able to increase about 150,000 barrels per day. What does this tell us? Some say that the spare capacity conversation has been inflated in terms of the numbers, but is this a cause for concern?
Absolutely. The spare capacity is often, of course, an issue around OPEC being always at the front burner of things. But looking at the countries in perspective that do these productions, you see, predominantly the UAE and has done 3-4 million barrels a day, now going to 5 million barrels. Discussions with with His Excellency, the CEO of ADNOC, has made that also very clear that they are increasing capacity. And on the other side, their very close neighbors, which is Saudi Arabia, has been steady on 10 to 11 million barrels a day. And so looking at the two together, it's about 16 million barrels per day. What that really means is that with these two big guns, they're doing just about perhaps even up to 15 to 16% of total OPEC production. So question now is if you're trying to increase their productions, by OPEC requirement, question will be again, what's the capacity that they can be able to do? And again, it's not a question of increased capacity over a short term, but what's the long-term impact on the market itself? These are areas which has to be managed within themselves as a country and as a nation.
How long do you expect this tightness to last? We know that the next meeting is coming up, of course, and there's going to be outcry. President Joe Biden will be in the Middle East this week. He may be able to press for something, maybe in exchange for something else. But how long do you expect the tightness in the market to last?
Well, the tightness would perhaps last as long as the market dictates. That's the best answer I can give. Because really, the market itself drives, what people can buy and what people can consume. And we've seen with the current issue that is befalling the Russian economy with sanctions from the US and even from the European side of things, there's always that bit of struggle because pressing for more oil will mean that the prices, again, of course, would have to drop. And when the prices even drop, then we have to go back and make sure that we sustain the demand. So it's almost like a circular motion for the consumers versus the producers. And yes, the US would need more oil because of their huge economy. US and India are big in consumption. But we also expect that this has to also be juxtaposed with the countries around other producers. We've got other countries that also live optimally from oil productions. We also get countries that also live out of the produce or out of the supply of this oil. So this has to also be checked. So to the answer, I think let the market really decide how that goes.
And beyond the market, let's talk about us. OPEC Plus is slowly returning to the nearly 10 million barrels per day that it agreed to pull from the market in April 2020. But we also see, of course, that the Ukraine-Russia war, that's entering its 5th month now. What do you think is going to be the projected impact on OPEC member countries as well as the world as we continue to deal with this insufficient supply?
Clearly, there are some clear impacts, and I think one of the issues that we would see is perhaps, first of all, it's security to supply, and also trying to look at how countries could manage with these supply disruptions. The security of supply will mean that countries who are being dependent on this oil consumption would have a bite on their revenues and of course in their budgets. But all in all, what is even clearer is, we expect this to be a bit resolved on time, and we hope that the August 2nd meeting will sort of, put some good notes on the table and be more positive. We also expect that the countries should be able to look inward and, do what they can to ensure that they sustain the targets of production, because it all goes around just on the same fashion. So increased productions mean that you have more revenues to say, and then you can also meet up with OPEC's targets. And when OPEC's targets are met, then, there seems to be a bit of a market balance in the prices.
All right, so we'll leave it at that. Of course, we're watching it very closely. We have another month to wait before we see if OPEC Plus decides to go in a different direction. Desmond, thank you as always for joining me.
Thank you very much and have a good day.
The same to you. And from a conversation about OPEC Plus and international crude oil prices, we have international business news with Lekan Onabanjo standing by. You are watching Business Edge, and that's coming up right after this.
Welcome to International Business News on Business Edge. I am Lekan Onabanjo. We start by telling you that the United Kingdom Infrastructure Bank has a pipeline of future deals worth £5 billion Great British pounds, according to the National Audit Office. A report by the NAO said the state-owned bank, which was set up last June to support economic growth in regional sectors across the UK, has already started handing out investments, despite some of its functions not yet going live. The bank, which has been allocated £22 billion Great British pounds of public funds, will pump cash through equity investments, loans and guarantees to support infrastructure projects. Reducing inflation will be the Czech central bank's priority. New Governor Alice Michel said in a statement on Friday, starting a 6-year term at the helm of the bank. The new governor said the institution will continue to pursue price stability in order to maintain low and stable inflation by targeting inflation. Mitchell resisted all steps in the bank's campaign of tightening interest rates over the past year, which brought the main repo rate to 7% last month from 0.25% a year ago. He, however, did not reveal any concrete views on the next course of policy in the statement. We also tell you that price pressures pushed headline inflation to 4.4% in Indonesia, accelerating past market expectation for a 4.2% rise. Food inflation was the main driver for the upside surprise, with food prices up by 8.3%. Transportation was the other major contributor to faster inflation, rising 5.5% as the global energy price surge filtered through to the domestic economy. Despite the breach of the target by headline inflation, core inflation stayed relatively subdued at 2.6%. And now the Indonesian financial authorities believe that imported inflation has yet to manifest onshore, but pressure on international depository receipts in recent weeks will still likely fuel additional inflation pressure. And finally, Australia's new Labour government has appointed a top scientist to lead a 6-month review of the country's carbon credits, following allegations that some projects earning credits are not really adding to carbon emissions reductions. Climate Change and Energy Minister Chris Bowen said the integrity of Australian carbon credit units issued by the government's Emissions Reduction Fund will be essential to help achieve the country's new pledge to cut carbon emissions by 43% from 2005 levels by 2030. And that's all on international business news. The conversation will continue. Do stay with us. It's time for Stock Market Watch on Business Edge, and on this conversation we want to consider the Nigerian Stock Exchange and that of the US, even as they have ended bearish in June. And to join the conversation we have Victor Aluyi, who is the investment analyst and head investments Sancora Global Investments. You are welcome, Victor.
Thank you for having me. Good morning.
So let's start with looking at the international market first. Now, U.S. Treasury yields eased for a second consecutive day, and the dollar rose on Wednesday after the Federal Reserve Chairman, that is Jerome, said that there is a risk the U.S. central bank's interest rate hikes could slow the economy too much. And he said the bigger risk is persistent inflation. So tell us, is inflation the bigger issue here, or should we talk about the slowing economic activity?
I think inflation really is front and center, and it's inflation that has led to the sort of policy move that we've seen, the aggressive policy move that we've seen from the Federal Reserve. And if we backtrack a little bit, it's a case where the Federal Reserve has essentially been late to try to rein in inflation. If you recall, inflation started to tick up early on last year, and essentially ticked up throughout the better part of last year. And the Federal Reserve had maintained a transitory narrative, essentially saying that the inflation that we're seeing was something that was going to just fizzle away. But that didn't quite happen. Obviously, supply chains had been snarled, and then you had the great reopening which happened last year, where essentially demand significantly outstripped supply, and then we started to see those moves on prices. You started to see those pressure on prices. At that point, I believe that the Federal Reserve could have started to take its foot off of the brakes. As a matter of fact, when we had 7% inflation print in the US, Federal Reserve was still maintaining a very, very accommodative policy stance. It was still buying bonds worth $95 billion on a monthly basis. So all of this has created a situation where inflation has become front and center. Obviously, if you throw the whole Russia-Ukraine situation on top of it, then it essentially exacerbates it further. So the policy posture that the Fed is basically having today is as a result of the fact that it needs to get inflation down as fast as it can. Unfortunately, I think that there are serious concerns around the ability of the Fed to midwife or birth a soft landing. So by that, I mean, bringing inflation down without necessarily significantly slowing output or creating a negative output growth or a recession, as you might call it. So I think that's the major issue now with the Fed. And there obviously right now are fears around a potential policy mistake. So these are things that we basically continue to monitor and keep an eye on. I'd say that inflation really is the key thing that needs to be taken care of right now, and not just from the U.S. Federal Reserve, from the global central banks. If you look at the ECB, you look at the Australian Reserve Bank, you look at the Swiss National Bank, you look at the BOE, everyone essentially is on a tightening stance. And, that is the major issue that needs to be tackled right now.
Okay, now, as the markets are bleeding, central banks around the world are trying so hard to actually rein in soaring living costs, with prices of essential goods like food and fuel set to be jumping. And some economists expect the U.S., the world's biggest economy, to go into recession as early as this year as interest rates continue to rise. So tell us, is there actually anything that can be done to stop the slide? Of course, because you understand that the U.S. market drives the economy of so many other country. So tell us, what can be done, if anything can be done?
Unfortunately, I don't think much can be done, really. It's important to point out here that, the Federal Reserve has never been able to bring down inflation by more than 400 basis points without inducing a recession. So the last CPI print was at 8.6. The Fed still has a target of 2%, which I think is a bit unrealistic because, as far as I'm concerned, inflation has become unanchored. So for the Fed to get close to its target is essentially going to have to bring inflation down by about 400 basis points. And if that happens, if they manage to engineer that, history tells us that it will certainly induce a recession. Beyond what the Fed is doing with inflation, there are other economic indicators that we've continued to monitor over the last couple of months that point us to the fact that we are going to see a slowdown towards the end of the year and probably a recession next year. Consumer confidence is at an all-time low. If you look at, the purchase of durable goods by consumers, that has also declined, quite significantly. And then you add on top of that, the Fed is on a tightening stance. Part of the tightening there, you also have to understand, is that beyond the interest rate increase, it has stopped its monthly purchase of bonds. But beyond that, it's also allowing its balance sheet to run up. So beyond the interest rate hikes, the Federal Reserve is from next month going to be taking out about 95 billion worth of cash from the system. Okay. So monetary conditions are going to become significantly tighter. Okay. The issue we are dealing with now essentially will be an interest rate risk, and that is what has roiled markets. The next level, we essentially be talking about a credit risk and then probably liquidity risk down the road.
All right, now let's look at Nigeria's bourse. Now, the Nigerian Exchange Limited ended June rather bearish. So what has put that bourse in that particular state as of now in terms of activities?
Well, I don't think that is surprising, really. The Nigerian bourse has essentially held up quite strongly this year against what we've seen in the international market. And the reason for that is because we have almost no international participation in the equities market at this time. So there seems to be a very strong decoupling between what goes on here and what happens abroad, because there's not much foreign money here. I mean, for obvious reasons. That is the major reason why, the Nigerian bourse seems to have performed quite strongly year to date. If you look at the performance for June, I think it was largely expected, really. We basically saw pockets of profit taking. Investors really looking to take cash off of the table. That is what has really, driven the market, year to date. And if you look across sectors, really, there's a reflection around what is also going on globally. So the NSE oil and gas index is up about 58%, and that has essentially tracked, crude oil prices. But if you look at the various other sectors, banking, you look at the consumer, the sort of moves that we've seen there are not, very strong. And this rally has basically been on the back of, significantly thinner volumes that we, typically see. So that is pretty much what has gone down with the Nigerian bourse thus far.
Well, that's a bit of a challenge for the two exchange rates, that is that of the US and Nigeria. Well, maybe respite will come their way sometime soon. It depends on their response so far to the global challenges and the global crisis that is affecting the market. But then thank you so much, Victor, for joining the conversation.
Thanks for having me.
And so we run off on a break now. When we return, it will be time for NC4 to watch. On NC4 to watch, let's tell you that Kenya's inflation hit a 58-month high in June on soaring prices of food items, breaching the government's upper limit target for the first time since August 2017. The inflation, a measure of annual changes in the cost of living, hit 7.9% in June from 7.1% in May. Moving on, the Nigerian National Petroleum Company Limited on Thursday said it had sold over $1 billion worth of natural gas to Portugal this year. It disclosed this during the Nigeria-Portugal Business and Trade Forum, which held on the sidelines of the state visit to Portugal by Nigeria's President Muhammadu Buhari. We also tell you that the rand weakened on Friday in early trade, a day after hitting a 20-month low on the back of extended power cuts and worries over the risk of a global recession. Earlier today, the rand traded at 16.37 rand against the dollar. And finally, oil headed for a third weekly drop, its longest losing run this year. On concern that a potential recession will cut into energy demand, WTI traded for August delivery added 0.2% to $105.94 a barrel on the New York Mercantile Exchange early today in Singapore. And that is the much of NC4 to watch that we'll take on the show. Tolu will take over the show now.
Thank you so much, Leka. So we've run through some of the big stories on the international scene, as well as OPEC Plus's decision to maintain their policy on production. And we looked into how inflation and interest rates in Nigeria could be linked. Those are the conversations we had today, but you can also check out our YouTube channel, and you can also check out our app, download it, and look back at some of the conversations we've had on African business, the economy, and finance right here on Business Edge. Until Monday, 11 a.m. West African time, I'm Tolulope Adeleru-Balogun. Do have a good one.